Welcome everyone to the Story Trading weekly meetup for VIP members only. Just a quick disclaimer, Story Trading is not an investment advisor. Investing in securities involves significant risk of loss. This presentation is being recorded and will be made available on YouTube to our non-VIP members after a embargo period of usually between 3 and 7 days, depending on the liquidity of the stock in question. So first, what's in a story trade? Story trading is the art of understanding market pricing. Also, we call that the story behind the trade through the lens of the 4 pillars of fundamentals, catalyst, sentiment, and technicals. We have an app that is actually out in private beta as of tomorrow. I guess it's out there in the stores. You can actually find it in the stores, but we're not giving out the invite codes yet. We'll be internally testing that and slowly over time inviting people to beta test our app. So that's going to be the place to discover, collaborate, and validate market moving information through crowdsourced research and social collaboration, which helps to discover that story behind the trade we're just talking about. Make sure to go to our website and sign up for a wait list for that app. Now, tonight we do VIP picks. VIP picks are presentations made by contributors. When they present here at a weekly meetup, we track the performance on our spreadsheet. You can find it at storytrading.com. Now, we've been getting a lot of attention recently, a ton of picks coming in. So we started a new process to vet picks. And honestly, I'm going to need some help. Probably going to have to bring on an intern from Columbia Business School or something like that. All these kids, they used to want to always get these Goldman Sachs internships and investment banking internships here in New York City. But I think now with the growth of story trading, we can pick some smart person off at a business school there and have them intern for us to help us through the vetting of all these ideas coming into story trading. So we only invite the top collaborators with the top picks coming to our community. So with that being said, we're about to invite contributor James Ticknor to present Augmedix, AUGX. It's on the OTC markets, last trade $5.99, a market cap of 162 million. James Ticknor has been a very active member of our community, especially with SMSI, really strong contributor and community advocate for story trading. We're excited to have him here for his first VIP pick presentation. Before I turn it over to him, just a couple of things. Here's the chart. So usually, the goal of what we do with the collaboration and story trading is to understand the history of the chart. That helps you make better decisions about, what's going to happen in the future and what kind of catalyst will turn that chart. This being said, this looks like some sort of new offering. We'll find out from James what's going on here. So this is going to be a little different, in terms of the chart and understanding the story behind the trade. Not much to go on there. And again, just a reminder of the 4 pillars, right? As we turn it over to James, we want to consider fundamentals, catalysts, sentiment, and technicals. So James, why don't you take it from here and let's try to understand the story behind the trade on this Augmedix. Is that the right word? Augmedix pick?
Yes, sir. That's name Augmedix. Let me just open up my screen sharing real quick. There we go. All right. Is that looking all right?
I see it. Looks great.
Okay.
Although we see your notes view, it's good enough, but up there in the display settings, you should be able to swap presenter view and slide. There you go. And that looks better for us. Thank you.
Awesomeness. Okay. So the company, as mentioned, is Augmedix. They are in the healthcare industry, but they are they provide services. So the post market cap after the S1, because they are planning to uplist through the Nasdaq and are currently in an S1 offering, will be approximately 283 million. And the shares outstanding at that time will be 54 million. So the typical process that happens, of course, when somebody goes in to visit their doctor is they go into the room. The doctor comes and sees them, they ask them questions, and their time is divided between writing down the medical notes and interacting with the actual patient. And then once the patient leaves, the doctor has to go and take those medical notes and input it into an electronic health record system, or EHR for short. So the ways has typically been done is through dictation, usually a voice recorder from their memory or from an in-person scribe. And each one of these has kind of different shortcomings associated with them. For example, with dictation, they still have to go and fill out the EHRs and search through their voice recordings to figure out, you know, what it is that they're looking for. If they're doing it from memory, as many of them do, there's a propensity for human error, and they can also forget to charge for compensable services that they've already given to the patient. And the kind of closest imitation of what Augmedix does, which I will get to in the next slide, is in-person scribes. In-person scribes are the people that follow the doctor and they write the medical notes for the doctor. Some of the issues that can come up with that is illegibility. The healthcare industry is notorious for having bad handwriting, and that can have a detrimental effect when inputting into the EHR. Their location is fixed to the doctor, which necessarily makes it to where they can't put it into the health record system, you know, instantaneously. They're typically med students, so there is a bit of a learning curve with those scribes as they're starting out. So it's not a perfectly seamless process anyway. And then also, lastly, you have another person in the patient's room, and the patient may not be comfortable with having someone other than their doctor in the room. And in conjunction with that, in-person scribes were declared non-essential when the COVID crisis happened, which left a gap in the market. So this is what Augmedix does, right? They are a virtual scribe, meaning that it's somebody in a cubicle who's acting as a scribe instead of following them around. And with that, they offer two services. The first service that they offer is called Notes. And basically what Notes does is it records either audio or video or both, or rather I should say it records audio and video or just audio. And that transcribes it into the system on the virtual scribe's end, and they complete the medical notes and upload it into the EHR. And the doctor will have that by the beginning of the next business day. The second service that they offer, and this is really their bread and butter, it's where 85% of their revenue comes from, is from their live services. So what differentiates Notes from live is that with live, you get the same medical documentation uploaded into the EHR, but it's done virtually instantly before the doctor leaves the room. And it also has certain value-added features to it, such as referral support, order support, and reminder support, things that further differentiate themselves from in-person scribe services. And the reason, if you'll notice at the top here, Notes came after the live version. And the reason why they made Notes was to upsell people to the live version. And it also gave them better access to small and mid-sized healthcare systems to where they may be more price sensitive. So to visualize how their product actually works, I'm going to shift through two slides real quickly, and then I'll spend time on each. The first one is Google Glasses. Yes, Google Glasses are indeed still a thing. They are just more targeted towards enterprises now, and this is one segment of the market for Google Glasses that they enter. But anyway, so the doctor wears these Google Glasses. There's a camera on the end of it, and there is a transparent display to where the doctor can see their scribe sending them messages, reminders saying, hey, you skipped a step in a checklist. And when they do the second version is a phone that they can also use in lieu of glasses. And basically it's just set up on a stand, or it can even be in the doctor's pocket. So to provide a hands-free and more mobile kind of companion. And with both of those, what happens is that the live stream is sent over to the scribe. The scribe compiles the medical notes on their end, and then once they're done compiling the medical note at the end of the interaction, they upload that into the electronic health record system. And the doctor just takes about 10 to 15 minutes, check the note to make sure everything's good, and they sign off on it. And the reason why that kind of 10, 15 minute time that they take to sign it off is important, I will also get to in a moment. And this is just a picture of what the scribe might look like in their cubicle. Oh, and it's also important, I think, to mention that these methods of communication, both for the streaming and for the location for where the scribe is at, are all HIPAA secured. So it's fully HIPAA compliant. There's no issues there. And I would also note that it works with telehealth as well. So if your doctor is, having to meet you through Zoom, as I had happened quite a few times actually since the pandemic started, both the live system and the note system are both fully functional with telehealth. And it also works for pop-up clinics and drive-up testing sites. That was more of a focus whenever the pandemic was kind of at its peak. So that's a bit about the product. So why should doctors and healthcare enterprises care about this at all? What's the return on investment for them? Well, there are several really good returns on investment that make this a worthwhile venture for them to actually use. And a lot of these points that add value to them are cohesive with each other and they build on each other. So the first value that it gives to them is about 2 to 3 hours that are saved every single workday for the doctor. So ordinarily doctors on average will work about 11 hours a day, and that takes it down to about 8 to 9 hours that they work. So they can actually go home or they can see more patients. And if they do see more patients, typically what's been reported is that they tend to see 1 to 2 patients on more on average. And that also makes it to where they're more productive and they're able to bill more for their services. And in conjunction with that, they're not missing billing for compensable services because everything's documented in real time or it's recorded for the scribe to give to them the next day. And one of, I think, the really nice things that people appreciate about this for those who are using the product is that they can actually be a doctor instead of a secretary and have organic conversations with the patient. That's actually the main reason why the founder of this company started it, because he was going to med school and he realized how long people or doctors were spending having to deal with the electronic health records requirements, which comprises about 1/3 of the doctor's workday. In conjunction, it also has a more accurate EHR entry, which serves as a better shield against medical malpractice suits. It has complete legibility, of course, because it's all digital. As I mentioned before, it has real-time entry, and that provides really good value, especially for patients who are under the care of multiple physicians. So that way, whenever a doctor completes a patient interaction, another doctor who may have an appointment with that patient can review the electronic health records before they go in rather than going in blind. Another benefit is it increases doctor work satisfaction by up to 49%. And that was the result of a survey that was sent out to their customers, Augmedix's customers, that is. It increases patient satisfaction, which is really important to the healthcare enterprise itself. Helps avoid burnout, which, as I'm sure we all know, doctors are really burnt out with COVID and how that's been going down. And the healthcare system, like hospitals and facilities, really care about that right now because it costs about $1 million to replace a single physician, representing a multi-billion problem for this particular kind of industry. And more practically, it also reduces COVID risk versus in-person scribes, which, as I mentioned, were declared non-essential personnel. So I want to talk a little bit about the market now, how big it is, and some some information about that. So right now they have identified approximately 300,000 doctors that they can address in the market for the United States, which represents a $6 billion market opportunity. And how they came to this number of about 300,000 was interesting, because I think it's actually a bit conservative, because this number that they've identified is just doctors who are below a certain productivity parameter, right? So it's not saying that these are the only physicians, you know, all these 300,000 who would be interested in our product. It's just the ones who are in most need of the product. So I liked how they arrived at that figure. But here's the really cool thing, and this is what caught my eye when I was just first going over this company. They have, of that 300,000 doctors that are there, 50,000, which is about 16% of the total addressable market, currently under contract. That to me was just stunning to realize. So of the 50,000 addressable physicians that are currently under contract with the healthcare enterprises, it's important to, I think, emphasize here that the healthcare enterprise and the doctor are kind of separate things. Think of the healthcare enterprise as a system of hospitals, and doctors, of course, as doctors. But it represents a $1 billion market just for who they, the healthcare enterprises that they have under contract. And they currently have less than 1% penetration under those healthcare systems they're contracted with. Right now, they have about 834 physicians who are currently using their product. And the average annual revenue per doctor for them right now is 300,000, or excuse me, 30,000. 300,000 would be sitting real pretty. But something I also wanted to note about the market is that there's very limited competition here. 60% of the new business that they generate is complete greenfield opportunity. And it makes sense, because the in-person scribes tend to be concentrated in large markets. You're not going to have that in more rural locations. And there's also certain challenges with having a qualified workforce, you know, around a hospital, because not all of them are created equal. And this point that I'm about to bring up here, it's tangentially related, but I think it's important because the CEO, and I also am inclined to think, thinks it validates this market, right? So Microsoft acquired Nuance, and what Nuance is they are pretty much a non-live medical scribe company, right? Among other things. But so they kind of compete with the notes aspect of it. Well, Microsoft purchased them for $14 billion with a B dollars, representing 14 or 16 billion. Apologize if I'm off there, but it represents the second largest acquisition in Microsoft's history. And the CEO, in regards to this market that we're talking about, had this to say. He said, this is, quote, "This is projected to be one of the fastest growing infrastructure software revenue streams in history." We'll see whether or not that turns out to be true. But one of the things that really attracted me in this company is that I got that market need. There's unequivocally a market need. And as a small personal note, I dated a doctor before. I know that filling out these charts, the electronic health records, is extremely time consuming and it wears you down. So I do strongly think there's a market need, and apparently so does the Microsoft CEO. So here, of course, you can see some of the major health systems that they have under their belt. I'll talk a little bit about them later. So now I think it's important to talk about financials. So on the left-hand side here, you have their revenues represented by the long blue bars, and you also have the gross margin, which is represented by the line. They went public in 2020 through a reverse merger, and were formally listed on the OTC, I think in March of this year. in a relatively short time frame, they went from a negative 33% gross margin up to a 41% gross margin as reported in 2020. And with the recent quarters, I have seen them achieve 46% gross margins. And I'll go into more about where you can expect it to kind of stabilize here in a moment. Secondly, on the right-hand side, you'll see the net revenue retention rate. So the net revenue retention rate is a good indicator for the stickiness of their product, which I believe it is extremely sticky. And if this is indeed an indicator, it seems to comport to that fact. So they have a net revenue retention rate of 129%. And that has been steadily increasing. It was at 108, then it went, I think, to 114%, and now it's at 129. And basically what that means is that for every dollar a customer gives them, they like the service so much that they expand on it and they give them an additional 29 cents. So, you know, if you're talking about millions of dollars, that translates into a very good chunk of money. So continuing on with the financials, the CEO projected an annual revenue growth rate of 30 to 45% for the next 3 to 4 years, which would represent a return to historical growth rates for 2018 through 2019. And I looked very carefully at this and built out a bunch of different models to determine whether or not this is accurate. And I think that it is certainly achievable. Whenever what impacted their growth rates, yeah, the chart won't show it, but what impacted their growth rates, of course, was COVID, and that just slowed them down to a 24% growth rate during that time period. So I do think a 30 to 45% growth rate is reasonable. They refinanced their loans for interest-only payments, and that will expire late next year. So that should help keep their costs down as they're going through this public offering and continuing to ramp up their revenue. The gross margin, as I mentioned before, it's expected to grow and to stay around 55% in the relatively near term. The IPO, I'm not sure if it really qualifies as a true IPO, but I'm going to call it that. The IPO offering is expected to generate between $36 to $40 million. I need to get some information about how exactly they're going to divvy that up. I was going to speak with them at the LD Micro conference, but because they're in the middle of an S1, they unfortunately weren't able to attend. But I have reached out to them and had some conversation there. So for the last bullet, right now they have not yet reached profitability. I do think that the business can be sustainable until they meet profitability with a wise usage of cash assets that they currently have on hand, and with the money that they're going to be raising through the offering. But that'll also be dependent upon management execution, which I do think that they'll be able to do. So for catalysts, they had a recent strategic partner, and mind you, this is with the preliminary Q3 report that they released most of this information except the last one, which was from the last quarter. They had a recent strategic partnership with a large physician-owned business, which covered thousands of physicians. So that's just adding to the number of addressable physicians, which was 50,000 that they currently have under contract and can penetrate. They also had a recent partnership with Google to integrate Google Cloud's medical speech recognition technology into their natural language processing models. And that's just a mouthful, so I'm going to make that simple here. It basically accelerates their ability to scale new clinicians, and it also lowers the qualification requirements for the scribes that they hire, right? Because that kind of feeds into their AI. It makes it to where the scribes are also spending less time per medical note, so they can actually be more productive and hopefully not have to hire as many people as they start to get more clinicians in service. And they also had their first successful deployment into an ER or emergency room environment. And so the customer that they had, interestingly enough, it's a veterinary clinic, right? So I didn't even think about treating non-humans. I don't expect that to be something they're specifically looking for and going to expand towards. But some good news coming from that is that the client expanded their use of the product within 1 month by adding another shift. And something else really important for this is it enables them to actually generate concrete data for marketing to other emergency room departments. And that, of course, can translate over to humans because a lot of the challenges are the same with the doctor being mobile, loud, noisy environments, which is why non-live services can be somewhat challenging, and things like that. Let's see what else we got. Okay, so for sentiment. So you guys saw the chart that Ben showed you in the beginning. It's thinly traded. That's because it's only been live for about 6 months on the OTC. And I expect there to be a kind of, there to be more liquidity and for it to be more regularly traded, the average volume to actually go up once it's actually on the Nasdaq. So the launch of Notes, the Notes product in 2020, I'm not sure if I said this or not, but I think I did. It's used to upsell to migrate the clients to live. And yeah, I did say this. Also serves as a stepping stone for more price-sensitive mid to small healthcare enterprises. The TAM, 300,000. I mentioned that, so I won't bore you to death with that. 6 months on the OTC, mentioned that. Yeah, okay, so competition. Their main competitor is Scribe America. Scribe America is an exclusively in-person scribe service, roughly I think of about 30,000 right now. And whenever they were declared non-essential personnel, it caused a huge disruption for Scribe America. And that kind of created a really good, I think, moment for them to be able to reach out with their sales and marketing team to start acquiring some of these people. And the doctors themselves as well are going to have higher burnout rates because the people that they had relied on for the service, now they're actually having to go into the EHRs themselves, which God only knows how long they've been out of practice in actually putting in the charts and data. As far as the risks about it, I probably should have made its own slide for this instead of including it on the sentiment one. I wanted to address the risk because I think it's good not to be too optimistic about a company and to look at it critically. These are the risks as I see it, the biggest risks. Number one, they've had significant losses and they're not yet profitable. That's kind of axiomatic, and that really depends on the management execution. Based on their history, I think that they can. So I think there's reason to believe that this risk is somewhat marginalized. Number two, like I said, dependent upon management execution. 3, sales are concentrated in a relatively small number of customers. As I mentioned, there's only about 834 customers, or rather clinicians in service under their belt. I expect that to grow rapidly, and because their approach is what I call a zombie bite approach. So typically when they have these healthcare enterprises that they're contracted with, they introduce it to a small number of clinicians within that enterprise for a kind of test run. And then if the doctors like it and if the healthcare enterprise likes it, they expand the offering to even more doctors within it. So once our sales and marketing team gets in, then they don't really have to even focus anymore on it. It just has to be the product speaking for itself, which is why I think the stickiness of it is so important, which it is extremely sticky. And the last risk, they may not have funds to pay liabilities. Again, I think this depends on a wise allocation of the cash that they're going to get and the ones that they already have. But I do think it is manageable. I'll have to get with management on that to illuminate some questions that I have regarding that. And I think this will be my last slide. So the moat, what is their moat? The first one is that they're the very first company to introduce virtual medical scribes. Every single one after this is just an imitator. They've been in this business, they know this business, and they've already gotten a very good head start in a market that is very, very young, but critically needed. They're also the only service among peers to offer 4 foundational elements to relieving documentation burden. They're ambient, they're mobile, they're remote, and they're real time. And they have added and will continue to add these value-added services. The ones that they have now were ones that doctors told them, hey, wouldn't it be nice if we had this to kind of supplement this service? And they've gone out and they've spent the R&D to make that happen. And they also have more coming down the pipeline. Just some, a little fun fact about the healthcare systems that they do have. The healthcare systems that they have, the relationships that they have are the top 4 out of 10 US healthcare systems in the country, and the top 7 out of 20 if you expand that more to the other contracts that they have. And lastly, the AI that they do have, which helps simplifies their workflow and make it easier for the scribes and make them work faster. It is indeed proprietary. Oh, and I'm not sure if I mentioned this, it lowers the scribe qualification requirements so they can actually get less educated people into these positions so that they don't have to pay them as much, which, by the way, is already pretty cheap because 90% of their workforce is in Bangladesh. Only 10% is here in the United States. So with that, I will open it up for questions. A little Batman reference with Jim Carrey as the Riddler.
Cool. I like that Jim Carrey here to lighten things up. That's pretty fun. So, James, I gotta say, that was an awesome presentation. I think you will instantly be well regarded as one of the best contributors here at StoryTrading pretty much overnight. So thank you for that. Actually, if you don't mind stopping your share, just so we can have a face-to-face conversation. Sure. Yeah, down the screen share over there.
Oh, it's up top here.
Oh, cool. There you are. Now I see you. All right. Excellent.
Hi, Jim Carrey.
So, yeah, but yeah, I'm very interested in the space. It's part of what I call like a digital healthcare revolution. I'm into Dario, Teladoc. There's lots of other healthcare stocks in the VIP story trading community that have been talked about. So, very compelling sector they're in. Man, you covered everything. I was taking notes. I'm like, let me ask him about risks later. And he covered the risks, the fundamentals, amazing. Let me just ask you one thing that I don't think it was covered. I was curious about. Sure. Do you know how they became public? I know they're doing this kind of IPO or uplisting, but how did they get listed in the first place to the OTC markets? The history behind how that came about. Anything about that?
Yeah, so it was through a reverse merger.
Oh, good. Okay. And how long ago was that?
That was in, I believe, around October of 2020, with an uplisting onto the OTC uplisting, with them being listed on the OTC in March or April of this year. No, last year.
Okay, cool. And guy, if anyone from the audience has any questions, this is the time to raise your hand or throw it in the chat.
Sure.
So just a comment, Google Glass, are you saying that's, I was surprised that's still around. I got like one of the very first versions of Google Glass, and I used it like how I thought you're supposed to use it, like almost 24/7, trying to make an extension of my body. And I got sick, man. I got this terrible headache. And then right after that, I got the flu for the very first time in my life. And I swore to myself it was because the thing kind of like weakened my immune system somehow. And yeah, no, maybe I'm wrong. Maybe it was a coincidence. But after that, I started getting the annual flu vaccine because that was a terrible experience getting the flu. And, but in any case, yeah, that's is Google actively selling those glass items through the enterprise sales?
Yes, they are. From my understanding, their cost, the price of it went down from initially when it first launched to 1,500, and I think it's around 900 now, if I'm not mistaken. So it's getting better. The battery life with the first iteration lasted 30 minutes. Now it lasts 8 hours. So that's really cool. And if I'm not mistaken, Google Glass is actually not as popular as just using the cell phones for some reason, which baffles me because I thought the glasses were cool. But I do want to correct myself for a moment. So October of 2020, reverse merger happened. March 2021 is when they went onto the OTC. I think I had made a mistake when I was describing that.
Okay.
There's just so much information on this company that I've been researching.
Awesome. Thank you for that clarification. Well, we got a first question in from Eric. He says, does Nuance really not compete here? They have AI, speech recognition, and medical as an area of focus.
Yeah, so I actually had anticipated that question. It's a very good question because it's one that I was wondering as well. Let me pull up the response I had typed out for it. So here's what I have. No, they will not be a strong competitor in this space if they do go that route. The CEO of Augmedix addressed this in the following way, quote, I think Microsoft coming into the space just brings more focus to this space that a lot of people kind of didn't realize existed and don't realize how large it is, end quote. They're not really worried about Microsoft. They could conceivably compete with them in the next several months to years, but only on the non-live version, which by the way is more incidental for Augmedix and a means to upsell again to their live service. And even so, 85% of the revenue stream from Augmedix is with their live service. So the money and the revenue that they have isn't really at risk with Nuance. And what else? And personally, I believe that Microsoft is just framing this in this particular way when they actually have an ulterior motive. So what happened earlier this year is Cortana's been a bust. Nobody uses that. They use Alexa, they use Siri, and all that jazz. So Cortana was discontinued except for PC earlier this year. A couple weeks later is when they announced this acquisition because Nuance owns Dragon Dictation software. And I don't think that Microsoft is going to make this kind of expenditure to go off and venture into a new market. I think it's going to be to reinforce their primary products, which has always struggled, particularly with contextualizing speech technology. Yeah, so that's my suspicion as for why they really bought it. But even if they really do want to get into this space, it's not really going to affect Augmedix in a meaningful way.
Okay, awesome. Thank you for that thorough answer. I have a question about valuation. I saw you talk about basically total addressable market. We kind of touched on their revenue in a roundabout way in terms of how many doctors they have signed up in the annual revenue. What can you tell us your thoughts on valuation, for those people who are strictly looking at the financials and not really speculating about the future, but just looking at the financials today? Do you have what are your thoughts on what is it worth? Because it's a 283 market cap. In your view, is there, how much upside is there here from that market cap?
I think, excuse me, I think that there's tremendous upside, and I will share my screen for a moment, if I may, because I actually built out forward-looking projections in two different scenarios.
Let's look at it.
Let me figure it out here. Share screen, screen one, share. Can you see now?
Yep.
Okay, so this is the history of their quarterlies going back to Q1 of 2019, before they even had the reverse merger. And you can see the growth rates have been really good on a per quarter basis. The average quarter of growth that they have is about 6%, which turns into an annual average of 24%. A lot of that, again, was because of COVID disruption in this area right here. But taking out the COVID areas and going with the 2018, 2019 years that I mentioned before, the growth rate is between 30 and 45%. Let's see, going to the past annuals and going into the future. So the yellow ones here are years not yet happened. If they have an average growth on the low end of what they have projected for the future of 30%, this is where I have them as far as their net income. Let's see. And this is with, like I said, conservative projections. If you go with the moderate projections, it looks more like this. But I would expect for them in 2025 to be profitable. If they really execute and nail getting these enterprises into their systems, and if the enterprises themselves actually spread this out faster, it could look really good. But even if they don't, and they go at a low end of the projected rate, 2025 is when I think that they should be profitable. And as long as they're smart about their money, I don't even think that they would necessarily have to do another offering. It's possible that they could, but I think that this company has a very good future ahead of it.
So James, looks like they're trading at 5 to 6 times, if I have that right, the 2024 revenue projections. Got about 47 million revenue and a 283 market cap. Do I have that right?
Yes.
Okay. So
Yeah.
how do we, but they're not profitable here yet. I'm wondering, are you looking at EV to revenue comparisons of, other companies that are kind of with a similar business model in terms of gross margins, or how do you figure out what it's worth, right?
Right.
In terms of the revenue multiple, perhaps, since they're not profitable yet, you don't have the profit, in there yet from 2025 and beyond.
Right. So I will share my notes. Sorry, you get some of my video. I'm a big video game guy, so you can see some of my video games. I will have, it's not really a DCF, but this is what I have for it. This is about where it is for me. I need to update some of these numbers because I got different information that changes the operational expenditure. But I want to point out before I go into this, which we can just kind of use as a springboard, right? That the reason I think why it's trading where it is now, between $5 and $6, is because in the prospectus that they filed, the initial public offering is going to be around $6 per share. And there is a net diluted net tangible book value of approximately $5.10. So that's why I think it's bumping up and down between that range. Whenever the actual offering happens, I think it's a 30-day period to where the book runner is supposed to keep it in that space. So it shouldn't move up and down too much because it's required to be within a certain range. So yeah, there's a little bit on that.
And what's the date? What's the timing of that offering?
I'm not entirely for sure. I do know when I called them and spoke to the executive management, they said on Friday they had closed out their round. So however long it takes them to uplist to the Nasdaq after that, I'm not entirely for sure.
Yeah, that's a very strong catalyst. When you look at the story trading method, it's not just about fundamentals, but very strong contributors, we believe, to price action, and market pricing is also catalyst and sentiment, to a lesser extent technical. So, when you have an uplisting to a higher exchange like the Nasdaq, you have events like this with an offering that might finish, and then you get rid of that kind of resistance, that $6 level. These could be very, very strong catalysts in terms of a story trade. So that's something to consider as well. At least the way we like to look at it, it's not just the fundamental value out in 2024. You have the 1176, but this could be a very strong trade opportunity. With that in mind, you keep the fundamentals in mind, right? To say, hey, this could be a stock that doubles in a few years, and now they're coming off of they're doing this uplisting. They have this catalyst. There might be some anticipation in the market, some speculation, and this could be a good trade. So that's part of it. And I'm not advocating either way. It could be, or it might not be. I really don't know. But that's a very awesome, thorough presentation. Do we have any other questions in chat? No, I think that's it. So James, that's an excellent presentation. I think we're going to move right along because it's 9:45. So I'm going to let people know over here. We've opened up an Augmedix research group. VIP members have access to that. AUGX Research Group, the link is in the VIP room. I have lots of VIP events coming up. Tomorrow morning, tomorrow afternoon, Monday, I think 1 p.m., we're going to be doing a big reveal on last week's pick. It was HCI. So we're going to be trying something new at StoryTrading. When we have VIP picks that are going to be revealed to the public about a week after the presentation, we will be revealing them on a YouTube live. So James, we're going to schedule this for early next week. We're going to jump on YouTube live and have a little bit of a discussion on your Augmedix pick and then direct people to tonight's recording. And in the future, we'll have an opportunity as well to follow up with the public. And there's going to be lots of exciting things happening, lots of new ways for contributors to be rewarded and appreciated for all of the contributions they're making to our community. So stay tuned. Follow us on YouTube. Follow us on Twitter. We're growing pretty quickly right now. And the more you support our community, the more it's going to help you and the VIP picks in our community. So with that, thank you, everyone. We're going to turn off our recording and go into our private trade of the week session. Thank you, everyone.